Netflix is set to report its first quarter results on Thursday after the market close. Here with what to watch in the streaming juggernaut's results is senior reporter Alexandra. Canal. Hey, Ali.
Hi, Maddie. Yeah, we have Netflix kicking off earnings season for the media giants, and all signs point to another solid report. As a reminder, the company will no longer disclose subscriber figures. In fact, this will be the first report that investors will not be receiving that metric, which means the focus this time around, it's going to be on revenue growth. And for the first quarter, we do have a double-digit gain expected. Netflix guided to an 11% surge for top-line sales. Average revenue per member, otherwise known as ARM, that should also see a boost from recent price increases in the US, UK, and Canada, along with steady subscriber additions, although any commentary on churn from those price increases will be closely watched on the call. Now, all of that should trickle through into further margin expansion, which the company is confident it can achieve. Currently, Netflix is projecting margins of 29% in 2025. That's up from last year's 27%. And finally, I want to quickly mention tariff impact, which is likely to affect the overall media business on the advertising side. According to an estimate from MoffettNathanson, tariffs could deliver a $45 billion hit to companies like Meta, Snap, Roku. They all make the majority of their money through ads, so they're the ones that are going to be most exposed here. But we could potentially see that trickle through into the TV and streaming side more prominently the longer this goes on. It's also possible that production costs will rise, and there could be retaliatory measures by other companies to limit the shows and movies foreign users can screen. So any further guidance or commentary on tariffs, what management is specifically watching out for, that's also going to be something to look out for in this report. And as we've been talking tariffs, we've also seen this dramatic decline of the US dollar, and that could actually be a foreign exchange tailwind for Netflix this quarter and for the future. We've seen a strong dollar negatively impact earnings previously, so perhaps potentially one positive catalyst here from all of this. But again, Netflix reports earnings after the bell on Thursday. Certainly a lot to look out for.
Netflix sees big growth in its ads business. The streaming company's ad-supported plan made up over half of new account signups in its fourth quarter. Netflix execs have said that 2025 will be the year its ad business transitions from a crawl to a walk. So what does the ads push mean for the future of streaming? Here to discuss, Melissa Otto, S&P Global Visible Alpha Head of TMT Research. Melissa, talk to me about Netflix's ability to scale their ad revenue. Just how much runway is there?
Thanks for having me. It's great to be here. In tech, it's always exciting. There's never a dull moment. In terms of the ad-supported business, this is an area of their fundamentals where we're seeing a lot of debate based on Visible Alpha consensus. Those FY 2027 estimates that are currently baked into the valuations range from $3.5 billion to $17 billion. So you've got real bulls and bears out there based on what their assumptions are around ads, the ability for Netflix to actually scale that business, and also the macro backdrop.
And talk to me about that macro backdrop. Just how exposed is Netflix? Because I've had sources say this is one of the most recession-proof names out there. Do you agree with that?
Coming into this quarter, based on Visible Alpha consensus, we have not seen their estimates move. The consensus is the same that it was last quarter coming into this quarter, whereas we have certainly seen that for other technology names in the space. In particular, we've seen Apple, their estimates have come down, consensus has come down. And so, you know, when I compare them, maybe it's the size of the exposure, the magnitude of the exposure, and what the rhetoric has been around the actual business model and space.
So Melissa, coming into earnings, are you comfortable with the valuation, 37 times forward? You got a $400 billion enterprise value on $7 billion of free cash flow. You know, that kind of compares to Disney, for instance. They've got $8.5 billion of free cash flow and maybe $190 billion enterprise value. Oh, and by the way, you get the parks and you get the experiences and you get the cruise ships for free. Just talk about what that means in terms of exceeding expectations, and now that they're not reporting subscribers, and you've seen Disney kind of stall at 178 million subscribers, and Netflix maybe stall at 300 million subscribers, what are your thoughts on the relative value?
I mean, it'll be interesting to see how the fundamentals actually shake out and what kind of commentary we actually get from senior management. They're going to guide the market. They're going to give us that strategic conviction in terms of whether we believe the bulls or the bears, like whose assumptions do we go with? Yeah. And in terms of Disney, we can't forget that they have a substantial amount of their business in the Far East. So they are also exposed. And I think net, it'll be interesting to see who's the bumper in this. Yeah. And that's really going to dictate what the right valuation is and where the trajectory of the price is going to go.
I do want to circle back to Apple, which you mentioned, obviously whipsawing a lot off the back of a slew of announcements, both the idea that they were going to be excluded from the worst of tariffs, but then we have sectoral tariffs coming. How are you modeling the net effect of that on Apple moving forward? If we do get these sectoral tariffs, is Apple in as good as a position as investors are acting like it is today?
I mean, it's a crazy backdrop at the moment. Forecasting anything it's got to be Monte Carlo. Give us a range of scenarios, and we're going to try to figure out which side it's on. Mm-hmm. I think this earnings season is going to be critical for these large bellwether companies. CEOs really need to shine and show the market what they're doing to navigate this, how we need to think about it, how the overall street estimates out there need to capture this. We can't have estimates all over the place. There needs to be some sort of conviction that consensus is accurately pricing in what the market is dictating.
Yeah. Netflix reporting first quarter earnings after the close on Thursday. Company announcing it will stop disclosing subscriber numbers this quarter, leaving investors looking for other indicators for the company's performance. From where we're bringing in now Alicia Reese. She's Vice President of Equity Research at Wedbush Securities. Alicia, great to see you. So Netflix earnings on deck, Alicia. What are you telling clients? What should they expect?
Well, we were a little concerned going into the quarter given the pretty significant price increases across the subscription tiers. But at the end of the quarter, we conducted our quarterly consumer survey, which showed that there was very little attrition on the service, very little churn, a lot of people still intending to come back to the service in the second quarter. Our fourth quarter survey before the price increases had indicated quite a few people coming back to the service after not having it for a while. I think just on content, this last year, Netflix gained so many subscribers, 15% in the first half, 16% in the second half. And on that, the viewership didn't go up very meaningfully. I think that was just because of the lack of content. So when you see that content really becoming a far more robust in 2025, and those price increases, that should keep a lot of those new subscribers and return subscribers on the service. I think overall, it's pretty positive, but we have to remember that Netflix isn't going to be giving us subscriber numbers or the average revenue per member, so it's going to be a little bit trickier to determine, where the stock is going to go once they report. But overall, I think it'll be positive.
Alicia, I'm so glad you just mentioned that because I can't help but feel when a company changes its metrics or stops reporting certain metrics, it's kind of like when a restaurant changes up its menu or when a company changes its name. What they're basically saying is something isn't going the way we'd like it and we need to reinvent. Am I being too harsh here?
I don't know if it's harsh, but I think what the reason that they're doing that is because in 2024 they were able to add so many subscribers because of the password sharing crackdown and because of the subscription or the advertising tier, which was much lower cost. So it was a lot easier to keep those members on the service versus them churning out because they want to save a buck or two for a few months. So now in 2025 they have a very different focus. And that is keeping subscribers on the service and raising price. And all their testing suggests that they could do this, that they could keep people on the service. And that's largely due to the content spend, the content quality becoming a lot more robust in 2025. After last year, we saw the SAG-AFTRA strikes that really impacted the quality of content available in the market. And Netflix is just so profitable. They have so much more money to put into that content versus their peers. So they're also adding live content like the WWE. And so they have a lot to offer. And I think they can raise that price. And our survey indicates that they saw little churn in the quarter because of that.
Alicia, I'm curious, if there was a material economic slowdown in the U.S., Alicia, what could that mean for Netflix?
Well, typically what we see, especially following the movies, is that people will cut travel, they'll cut expensive purchases, and they'll stay home a bit more. For Netflix, that's great. The more people are home, the more they're going to seek in-home entertainment or perhaps going out to the movies. So that really benefits Netflix. On the other side, they're trying to grow their advertising model, and if they don't have advertisers spending as much, culling their budgets, that might impact the advertising tier growth for them and the revenue that they can derive from that.
Alicia, I'm curious, any new super hot hits coming out of Netflix? I think about Drive to Survive, which completely changed the trajectory of F1, changed my trajectory too. I now go to F1 races. Yeah. Is there a next super show that's coming up, or maybe even a couple of them?
Well, I think Netflix is, I think we are going to see the benefit, not for Netflix, but for the movies in general, F1 coming out this summer. I think that's going to be a big hit. F1 is up for grabs, it sounds like, and there are a couple other sports properties that are up for grabs. So Netflix might make some, waves by purchasing some more sports content, some more live content after the WWE. But just the content that's coming out right now, there are quite a few really good shows. Frankly, they have to compete with some other big properties out there like The Last of Us. But so far, they have some really good breadth and depth and live content quality. So it's really just the balance of that where they have something for everyone right now.
Alicia, final question here. Looking at the stock, it is up nearly 55% over the past 12 months. Alicia, how do you think about valuation for this one?
Yeah, the valuation is a little bit trickier now because they're not getting the subscriber numbers. And so it's just a basis of revenue growth capabilities, and they have to beat that revenue guidance by quite a large margin now, I think, because they're not giving subscribers. And what investors want to see is just expansion of that free cash flow. So if you're expanding that free cash flow pretty meaningfully, the shares could continue to go up. It's been a little bumpy as through the beginning of the year because of these reasons, because people aren't sure as much what to expect. But I think they can continue to, expand as long as that free cash flow continues to expand.
Alicia, great to have you on the show today. Thanks so much for your time.
My pleasure. Thanks for having me.